let's kick things off for today's webinar. Welcome everybody. Unit trust investments in a self-managed superannuation fund. For those that joined last month, I talked about property investments in a self-managed fund, and I touched on, albeit in a fairly brief and speedy manner, the concept of investing via a unit trust. And so I wanted to expand on that a little bit further today and talk through unit trust investments sort of as a broader subject matter, because one thing's for sure in the SMSF space, and I know from ourselves administratively how we deal with a lot of funds that have investments in unit trusts, and certainly over the last few years when people were looking for different sorts of returns, people have looked for different investment vehicles, and the unit trust is one that regularly comes up with regards to this space. So firstly, obviously from a disclaimer point of view, I guess my biggest disclaimer that I would always make with this one is that I'm not actually an accountant by qualification. So, you know, I'm talking about unit trusts primarily from an investment vehicle point of view and assist compliance point of view, not so much from an accounting point of view and the accounting benefits associated with it. But what I do want to touch on through the presentation at different times is how the accounting and the way that the accounting of the unit trust can misrepresent transactions from an SMSF point of view, and ultimately that can lead to compliance concerns, and often is the case that we often see a situation where the financials might have to be amended to represent or replicate what's actually occurred versus what has been written down from an accounting point of view. So some of the outcomes that we'll talk through today, or that you'll hopefully get out of today's session, is the distinctions between investing in related versus non-related unit trusts, how property development can influence the tax outcomes, and again, I did last year I did a property development presentation, and I'll touch again on my workshops that are coming up in November, which will be property driven, and that'll sort of cover off on a lot of these things in far greater detail. But you know, there's nothing wrong, or there's nothing stopping a self-managed super fund from undertaking property development, albeit that when a fund does, we need to understand what the ramifications of the transactions are, and what the potential tax implications, and again, whether or not you're dealing with a related party in that sense, can also have broader ramifications for the fund as well. Trust distributions, again, a very significant issue, and it's an issue that's been around forever and a day. You know, I joined the SMSF industry right from the get-go, and unit trust distributions has been a constant sort of thorn in the SMSF investment environment, and so it's an area that we need to make sure that people are on top of with regards to funds if they're holding investments particularly in a private unit trust. And then how pre-99 unit trusts and 1322C trusts can work side by side, or how you can have one within the other as well from an investment point of view. And again, it's not common that you see pre-99 unit trusts, but if you've got them on your books from an accounting point of view, from an admin point of view, then you clearly want to make sure that all of the accounting and all the transactions are done appropriately, so that clients don't get themselves into too much trouble. And I'll identify a couple of cases that I've seen recently where we've seen problems arising with pre-99 unit trusts that could have been avoided with the accounting side of the transaction. So again, a couple of things that I like to do is you know that I like to put a broad sort of approach to a number of these issues, and how I see them, and try to identify the issues when dealing in this space. And so from a unit trust consideration point of view, it's not too dissimilar to the whole concept of investing in property inside the super fund environment. So if we look at things like Section 62, the sole purpose test, and you know, what is the purpose behind the investment that the fund is making? Is it there to provide retirement benefits for the members? Then we're ticking that box there. Issues associated with things such as there's borrowing rules, and whilst today I'm not going to be touching too heavily on limited recourse borrowing arrangements, just appreciating that from an LRBA point of view, if you're looking to invest in unit trusts, then you're unlikely or less likely to find a commercial lender. And then how are you actually benchmarking any related party loan against anything commercially without potentially attracting the attention of the tax office? So you need to be mindful of those matters, the arm's length requirements, the financial assistance, and definitely the acquisition of assets from related parties. But then more broadly, tax office rulings that have been issued across the time. So things such as SMSF 2009-4 and 2009-3 that deal specifically with in-house assets, but also with unpaid present entitlements on trusts. And I want to touch on a little bit of that 2009-3 a little bit later in the presentation as well. The arm's length income requirements. Again, it's saying that I'm a little bit like a dog with a bone in this area, that a lot of my presentations are raising the issues of non-arm's length incomes, and particularly non-arm's length expenditure, and investing in a unit trust is well and truly in the target area of that non-arm's length expenditure area, because there's no sort of carve out, there's no sort of compliance umbrella where people are getting protection from the new gnarly provisions for unit trust investments. A lot of the issues, as I've spoken about before, are around general fund expenses, not specific fund expenses. So we just need to be mindful of that. The SMSF regulatory bulletin 2020/1, which talked about property development, is another good resource. And I've highlighted a couple of cases there, Aussie Golfer and Montgomery Wools. You know, the SMSF industry, if you want to go back and do your research, there's plenty of good cases that give information about various trust style investments. And whilst Montgomery Wools was one where a fund invested in a unit trust, and that unit trust undertook activities that were effectively in breach of ultimately the sole purpose test, it was found that there was other arm's length issues inside SIS that weren't necessarily pushed by the tribunal there. Similarly with Aussie Golfer, the sole purpose test was not created as an issue, or was deemed not to be an issue by the courts, but certainly the structure of the trust, the ATO took it upon themselves to use their powers within the SIS Act to deem the investment to be an in-house asset if the courts didn't already deem it an in-house asset. And so, you know, they're good examples of investments in trusts where if you don't do your thorough research as an SMSF trustee, you could find yourself in some form of investment strife, in the sense that something might be considered an in-house asset where you otherwise didn't want it considered an in-house asset. So like I say, with most compliance issues around self-managed super fund, you're normally dealing with more than one area. And so you need to appreciate what that means from the fund's existence. And of course, like down that middle there with the Part 8 associates, the in-house asset exemptions and the 1322C arrangements, you know, they all get tied together around this concept of investing in a trust from a self-managed super fund point of view. So let me start on that arm's length consideration. Before I get specific into the various types of trust investments that we tend to see for the most part of the SMSF environment, let me sort of reiterate some of the points that I've previously raised around the arm's length considerations. So we know that section 295/550 is what gives the capacity for the commissioner to impose non-arm's length income. Now, we also know that the ramifications for a self-managed super fund is pretty critical, given that we're moving from a 15 or potentially a 0% tax environment up to a 45% tax environment. And that, you know, is relatively substantial for the sake of whether or not a transaction is done on an arm's length basis. And this whole non-arm's length expenditure, and particularly the transactions within a unit trust, have specific exclusions or inclusions, in that 295/550 that identify that transactions inside an entity, you know, that the fund has invested in, will be counted for non-arm's length purposes. So we need to be mindful about that. But further to that, and again, from a trust point of view, we need to appreciate that any discretionary trust distribution that is paid into a self-managed superannuation fund is going to be non-arm's length income, full stop. So it doesn't matter what it's linked to. If there's any income that is not directly attributable to a self-managed super fund investment in a fixed entity, then it's going to be treated as non-arm's length income. And that is in many ways an issue that stemmed from people trying to funnel money from other entities inside super, where they see the tax benefits of 15%, and they try to draw on that. So, well, if we actually make an allocation to the super fund, then it's going to be treated taxed at 15. But if it's from a discretionary trust, then it's going to be taxed at 45. Now, where a lot of funds can potentially get caught out, and the concept of around the same time as Montgomery Wools, there were a number of other cases back in sort of the early 2000s, where a number of funds would have an investment in a fixed or a fixed investment in a unit trust, and then that unit trust would actually receive income from another trust, that potentially a family trust or whatever. And so the unit trust was receiving the discretionary income, and then that discretionary income was getting mixed in with the fixed income that the unit trust was generating and being distributed to the super fund. And so the whole gnarly provisions will continue to work their way up to make sure that all income from the trust that is distributed to a super fund is exclusively related to the investments of that trust. So again, we just need to make sure that these investments are clean. Income derived from a scheme which parties are not dealing with at arm's length. Again, this is when we're looking at if we've got related parties involved in the transactions of the unit trust. We have a tax issue. We also under SIS will have a 1322D issue, which will then create a problem for the trust and make it untenable for the fund to keep the trust and have to unwind the transaction. So not only do we create a compliance issue for the fund by not dealing at arm's length, we also create a tax issue for the funds. And all of these sorts of things are extremely problematic. We're in an environment at the moment because of the COVID relief that was issued sort of in the 2020-21 period, 19-20 as well, but then and has extended on beyond that. We're in a situation where there are a lot of non-arm's length income matters occurring inside these trusts that have got specific exceptions to the rules at the moment that we need to be mindful of. So rental deferrals would otherwise be an in-house asset and potentially create a problem for the trust itself, but we've got relief under various COVID measures. It's really important that we know that relief only applies for whatever deferral was provided at that point in time, and that deferral had effectively an end date as far as leasing arrangements and things, and we need to make sure that trustees in those situations are keeping up with collecting of that deferred rent to ensure that they don't have an in-house asset issue into the future. So the LCR that was finalised in 2021 is problematic for unit trust investments for superannuation fund, but also if we dig deeper into that, issues like self-managed super fund ruling 2010-1, which highlights issues around acquiring assets from a related party. If we dig into the rules around 1322C, then there are issues around acquiring assets from a related party, which we can then broaden out to start to talk about issues like related party builders and acquiring of materials from related party builders. So anything that we are applying to an SMSF in a direct transactional way with property buildings and maintenance and improvements, we can then subsequently apply to any investment inside the unit trust that it in itself will create problems as well. So from an arm's length point of view, we just need to be mindful of that. So what an SMSF shouldn't do? Well, obviously it shouldn't invest in discretionary or hybrid trust. Now I've written hybrid trust there because I've seen situations where a self-managed superannuation fund will invest or will acquire fixed units in a trust. And so in their mind, they're going, well, I've actually bought 5,000 units in this unit trust. That means I'm entitled to the income associated with those 5,000 units, so subject to however many units all the other unit holders have. But then as you read through the trust deed, it talks about other discretionary or maybe potentially business income that trust is generating that can be distributed based on other means. And so this hybrid trust approach, which is part fixed, part discretionary, is going to be problematic for a self-managed superannuation fund. So it's critical that when we're setting up these unit trusts, that we're looking at the deed to make sure that it doesn't give any potential to create future compliance problems for the superannuation fund. Now, when I'm seeing these issues, I'm talking about in the last 1 or 2 financial years. I'm not talking about 10, 15 years ago. So we know that these transactions are still occurring. And where you see it a lot more is, and many of you would have had these sorts of questions where you might have medical practices or other practices that are being set up, and they're saying, okay, well, how do we acquire the business premises for the practice, and they'll acquire it through a unit trust, and then all of the various partners in that practice will invest in the unit trust potentially through their self-managed super fund. but then, and that in itself is no issue, but then subsequently they have this capacity to have the income that's generated from the business filtered through there to ensure that they can do income splitting or whatever it might be. And once we start heading down that path, then we've got a massive problem for the self-managed superannuation fund. So investing in discretionary or hybrid trusts is definitely a no-no. Obviously, receiving that discretionary trust distribution, as I talked about before, we've got to make sure that we avoid that at all costs, because not only will a discretionary trust distribution be non-arm's length income, because it's not actually income associated with the asset of a fund, then it has to be deemed as something else, and the only other thing it's going to be deemed as is a non-concessional contribution in the eyes of the tax office. And so if that's the case, then you may potentially also be creating excess contribution issues for funds as well. So, all these sorts of things we need to be mindful of. And if you tie them all together, what it really comes down to saying is that we need to make sure that self-managed super funds aren't entering into transactions blindly or with little guidance. And by that, I mean that most people will not just blindly enter into a unit trust transaction. They will normally do it on some form of advice. How thorough is that advice? Where's that advice come from? What's the process behind determining if that is appropriate advice? And I'm never shy of saying to people, go out and seek SMSF advice from the ATO on some of these issues if you can. I mean, clearly getting a legal opinion on a lot of these transactions may be beneficial. Certainly, I think it can't hurt to get it. And the tax office themselves, in a number of their publications around property development, that say you're best to seek professional advice on it. Just be mindful that you've still got to do your due diligence as a trustee to make sure that the transaction is appropriate. And this last one, deal with accountants with SMSF knowledge. I think this is one that we tend to come across a lot as an industry. And if you administer funds, if you advise on funds, if you're auditing funds and you're dealing with it, and then you're having to obtain financial statements from the unit trust that a fund has invested in, those financial statements will often come in multiple various formats, and they will utilize multiple different terms. So, things like trust distributions, what are they classified as? Unpaid present entitlements, where are they being reported and recorded inside the financial statements? Has anybody used that horror term loan? Again, I see that, loans to beneficiaries, where it's not a loan, it's an unpaid present entitlement. Well, rather than having to go back and amend it, if we're dealing with parties that understand and appreciate the rules around self-managed superannuation funds, then we're clearly in a much better situation. And I'm going to touch on or finish off today when talking about valuations and the problems that I've seen in that space as well. So, they're just a couple of points that I would say that we need to be thinking about from an SMSF point of view. So, one of the things that I wanted to address in today's presentation is the concept of a related trust versus an unrelated trust. And so, whilst this is a bit of a broad approach here, I'll go through the 1322C arrangements in a little bit more detail in a moment. But basically, what we've got is our 1322C non-geared related trust, and that has no debt, no investments in other entities, can lease business real property, can acquire business real property, can develop but can't carry on a business, and then all transactions are on arm's length basis. As I said, I'll touch on that. So it's very strict to be considered a non-geared trust, and therefore to be exempt from the in-house asset rules. Otherwise, if you've got an investment in a related trust, and I'll touch on what a related trust is in a moment, but if you've got an investment in a related trust that doesn't meet all these conditions, then it's going to be an in-house asset. Now, fundamentally, there's nothing wrong with that if it represents less than 5% of the assets of the fund. But given that most of these investments are disproportionately large compared to, say, your average stock style investment, then you're almost always going to find that these trust investments are going to represent greater than 5%. So we need to make sure that we're either well aware of the 5% rule and are keeping the investment in the related trust that has all sorts of activities under 5%, or we're sticking to the 1322C requirements and ensuring that we don't breach it to make sure that we can invest up to 100% of the fund assets in it. So that's our non-geared or related trust. Then we've got our unrelated trusts. And again, unrelated versus related, I'll touch on that. Basically, we can invest in anything. We can do whatever we want. So, well, not whatever we want, but we can do whatever investment we feel is appropriate on an arm's length basis and all those other issues without having to consider the requirements of the SIS legislation. So it can't be related, but it can be 50-50 ownership. I'll come back to that. It's ideal for unrelated business associates. So this is a situation, and again, depending on how many of you have been in the SMSF industry for sort of over that longevity period back to 99 and even before that, you'll know that a lot of self-managed super funds and excluded funds in the early days were set up with business associates, and those business associates would join the same fund and then they would hold the property in the fund. Well, they've tarnished that transaction, or that transaction's tarnished because they've joined the same fund together, and so it will always be a related trust. But if you've got unrelated business associates with their own self-managed superannuation funds, and they both invest 50-50 into a unit trust, and they get all the control issues right, then that trust can be unrelated, and the way that trust transacts is far broader than under the 1322C requirement. So there is always that issue with business associates about whether they're in the same fund or not, and the short answer is they shouldn't be if they want to keep everything unrelated. These unrelated trusts can borrow, can develop, can improve, can buy shares, can hold insurance, can run a business. So it can do a number of different things that you can't otherwise do in a related trust. But to do that, you've got to be aware of the control issues. So in a very simple manner, from looking at what an unrelated trust looks like, if you've got self-managed super fund 1 and a relative of that self-managed super fund investing in the trust, if you've got self-managed super fund number 2 and a member of that self-managed super fund investing, and then you've got SMSF 3 investing, and between them nobody has more than 50%, then so long as Group 1, Group 2, and Group 3 aren't related to each other, then this unit trust can ultimately do anything that it chooses, again, so long as it's done on a commercial basis. So keeping those groups separate is key to understanding the relationship of control. Now, where this transaction becomes interesting is if SMSF 3 wants to sell their investment, right? So if SMSF 3 wants to get out of this unit trust, then what are they going to do with their 25%, right? So do they split it and they give 20% to Group 1 and 5% to Group 2? Do we find another unrelated entity to come in and acquire that 25%? They're the conversations that need to be taken into consideration, because if they sell all 25% to either Group 2 or Group 1, then they're creating a related trust for that entity or for that self-managed superannuation fund, and then the activities are going to come under a far greater scrutiny. And if that scrutiny results in it being in breach of the 1322C regulations, and so then they have to unwind it, well, then how do they unwind it? Do they end up selling it to the other group? And if they end up selling it to the other group, then they've then just exacerbated that issue and created a problem for the third party. So we need to be mindful that we have a clear understanding of who related parties are, so who our related entities, who our family members and all those other things are with reference to unrelated trusts. And it's clearly a difficult issue when it comes down to the nitty-gritty of some transactions, some company investments, some other trust investments, some partnerships, as to what the relationship actually is. So we just need to get clarity, and ultimately that's where you do want to get that advice up front to make sure that people are not related so they can enter into this transaction. So that's one part of control, but control is more than that percentage. And I think this is the area that I guess stimulates a lot of conversation, whether it then stimulates a lot of positive activity in the industry or not, and whether we get enough support from a regulatory point of view is another issue. There's certainly been smatterings of cases potentially not related to self-managed superannuation funds, but to income tax laws around sufficient influence or not to determine whether or not somebody does influence the trustees of a trust. But we need to be mindful of that. So clearly, under the SIS Act, we are controlling a trust if we have a fixed entitlement to more than 50% of the capital or income of the trust. So clearly that 50-50 ticks the box on point A of section 70E of the SIS Act. So no issue there. Then if we jump to point C, it says if a group in relation to the entity is able to remove or appoint the trustee or a majority of the trustees of the trust. So therefore, again, if we go back to the previous diagram, if any of those groups 1, 2, or 3, who are each individually related group, if any of them have the capacity to appoint or remove the trustee, then that group would control it. Now, you would assume based on unit holdings alone that nobody has that capacity. But what does the trustee company say? So if you've got a trustee company or a company acting as trustee of the unit trust, then what does the Constitution say around who has the casting vote in a meeting? So you're looking for all of those sorts of issues to determine who has that capacity to appoint and remove the trustees. Do you have an appointer? Like, so does the deed have an appointer? Is that appointer unrelated to the other parties, or is that appointer somehow related to any of those groups? So all of those issues can become quite complex. But of course, B is the big one, this concept of sufficient influence. You know, and I'll read it out. It's a mouthful, obviously, but the trustees of the trust or a majority of the trustees of the trust are accustomed or under obligation, whether informal or informal, might reasonably be expected to act in accordance with the directions, instructions, or wishes of a group in relation to the entity, whether those directions, instructions, or wishes or things that might be reasonably expected to be communicated directly through the imposed company's partnership or trust. So very quickly running through that from a concept point of view, and I always kind of go back to a number of Monty Python scenes when I sort of read that out, is you know, bringing in all the parties to the conversation piece, is it doesn't have to be a formal arrangement. So, you know, informally, you don't have to be on the board of directors or whatever to control the way that the company operates. And in some instances, you'll see people deliberately kept off the company, but have control. And I often raise, when I'm talking about property development, I often raise a case here from South Australia, which had a little bit to do with disability housing and the building of disability housing. And one of the parties to that was actually a disqualified builder. Now, he didn't tell the other party that he was disqualified, but when they set the company up to set up the joint venture, he didn't get appointed as a director of that company. Now, there's a couple of reasons for that. One, and the main one, was he was disqualified, so he couldn't actually be the director of that company. But what the courts determined, quite appropriately, was that he controlled that company. So even though he wasn't a director of the company, he actually controlled the decision-making of that company based on his experience in the building area. So sufficient influence can be a significant thing. So what's really important when we're looking at control is coming back to this concept of making sure that we check the deed of the unit trust. Not only are we checking it to make sure that it's not a discretionary trust or a hybrid trust in that way, shape, or form, but also around the appointment and removal of trusteeship, to ensure that no one or none of the parties associated with that transaction have the capacity to control the trust. And I wanted to I guess, raise this because when we talk about sufficient influence, it's a little bit like talking about the sole purpose test. And the tax office have addressed this. They first addressed it back in the 2008 ruling from the sole purpose test, and that is the concept of subjectivity versus objectivity. And one of the things about subjectivity is it's kind of what's in your head, right? You know, this is how I think, or this is why I want to do it, or I believe that I'm in accordance with the sole purpose test because my mind tells me that everything's in accordance with the sole purpose test. But objectively, which is the tax office, they will just look exclusively at the facts, right? So they will look at all of the parties associated with the transaction, and they will determine whether or not, and we're talking about a fund, obviously, if it goes toward it and has a review of the transactions being undertaken, they will look at all of the transactions to determine whether or not, objectively, factually, somebody has control. If that person has control, then it would be a related trust in that instance for the superannuation fund, and it would then be subject to the related trust rules or the related trust exceptions, and you'd need to be able to go through that process. So what we think versus what's actual fact is always critical, and it's just as critical, obviously, from a sole purpose test point of view, which is the first time the industry has really had to address this subjective versus objective. But similarly, with the idea of control, it is the actual facts around the case that are going to be the determining factor. And so it's really important that when you're talking to your clients about these things and they're looking to set up trusts, that they look at it all objectively and they identify all of the key issues around control to make sure that there is no control, right, or no assumed control there. And I think that's a critical issue to be mindful of. It's almost the modern day equivalent of literally versus figuratively, but it's a little bit more of an old school way of looking at it. Then go and touch on the investing via related entities. So if we talk about an unrelated trust, as I had that diagram up there before, you can do whatever you want in the sense that you might go out there and you want to do property development, and you're engaging lots of other parties, or you get a number of superannuation funds to invest to expand your capital of the trust, to expand how big the project might be. But if you look at unrelated trusts in a different format, you're going to start to touch on issues such as investment, or just purely investment trusts, so professional investment trusts, where you might have a lot of like-minded clients who want to get access to wholesale investments or whatever it might be that they can't otherwise obtain. And so by putting them all into some form of professional investment trust, then they can get access to it, and it's not in breach of 1322C, because albeit they're investing in another entity, it's not related. So, you've got these other various reasons to do it. So, we look at unrelated trusts largely as property style transactions, but more broadly in the investment scheme of things in the SMSF space, we actually see it occurring on a more regular basis as pure investment platforms for a client base of the various firms out there. So when we're looking at investing via related entities, what we're addressing is that we're talking about these non-geared unit companies. So I'm not talking about companies today, and largely there's a few differences between company and trust investments. One being about retained profits and other things, and franking credits and other areas like that. But most self-managed super funds tend to go down the path of unit trust, so that will be the focus. There is a general exemption for a non-geared unit trust under the in-house asset rules. So that's what makes this style of investment attractive for the majority of clients that are looking at investing in property, is that they get that general exemption under the in-house asset rules. Right? They also have an exemption under the acquisition of assets from a related party rule. And to me, that is one of the big bonuses of it. And going back to the property presentation that I did last month, when we're talking about acquiring investments in or a residential property sort of as an investment property, when we're looking at those sorts of different things, whether we do it directly, whether we do it as tenants in common, they're very restrictive, right? Unless you've got the capacity to outlay the funds up front, or unless you've got the desire to borrow, then they are problematic. Whereas doing it via an ungeared unit trust does give us the capacity to acquire these investment vehicles up front, partially as a super fund, partially with another party, and then potentially acquire units from that other party as we go along. So from an acquisition of an assets point of view, it's a very palatable approach to take. It is effective, as I said, from acquiring property. It does give us that capacity to do ongoing transfers, both in and out. So again, it actually forms the basis of meeting a condition of release, where we're looking at potentially freeing up some capital to fund or transferring assets outside of super. We can look at a transfer of assets later, of course, from a sole purpose test point of view. That's not our purpose of acquiring property. It's not to buy property to be able to utilize later in life, but as long as it's there to provide for our retirement benefits. But the other thing is too, we might potentially be able to fund money back in to the super fund, so other parties come in later to help pay out benefits. So you might have retiring members and younger members come into the fund in the 6-member fund environment, and they will make contributions and therefore be able to buy more units and therefore free up capital in the fund or cash in the fund to pay out benefits to retiring or deceased members. But the issue associated with it is that these investments are tightly regulated. So under 1322C, what we know and what we need to be mindful of is that these regulations apply to funds with no more than 6 members. So they are our self-managed superannuation funds. The trust does not borrow. Okay, so there can be no borrowings associated with the trust for it to satisfy the 1322C requirement. It doesn't loan money to individuals or other entities. So the only money that the fund can have is money that is sitting on deposit in a bank, and it's got to be an approved deposit-taking institution. So you've got to go through the list of who an approved deposit-taking institution is. It's fairly broad here in Australia from an investment point of view, but the trust does not lend money elsewhere to satisfy these conditions. Has not acquired assets from a related party of the super fund other than business real property. And so that becomes really critical when we're looking at issues such as property development and the like, when we then refer to things of related party builders and the supplying of equipment and materials. Now, this then stems back to the same situation as it would if we were investing in property directly and we engage with a related party builder to undertake improvements or to build the property, and they actually supply the materials, then we're actually acquiring those materials from a related party, and it's going to be problematic. The same thing is going to apply under a 1322C arrangement, so we need to be mindful of that. Does not lease assets to a related party other than business real property on an arm's length basis. So again, this is where there's been a bit of a scope through COVID where, you know, the whole rent relief that was provided from a property point of view extended to 1322C trust or ungeared property trust. So we were able to provide that rent relief, but we had to make sure that that rent relief was also provided on an arm's length basis. So it was no more or less than it would be had that party not have been related to us. So again, arm's length is what we're looking at with all these situations. Does not carry on a business. And I'm going to touch on that property development thing again in a moment, or the concept of property development and what that actually means with reference to an investment via a unit trust. So it's one to be mindful of, because again, if you look at the unrelated trust, or if you look at the in-house asset with the 5% rules, or you look at a pre-1999 unit trust, then you don't have that carrying on a business exclusion. And so in the unrelated trust environment, the trust can carry on a business, but in the SMSF exclusion zone, we have to make sure that we're not carrying on that business, and conducts all other transactions on an arm's length basis. So again, not only have we got the tax implications of arm's length, we've also got the SIS regulatory implications of arm's length. And for me, the 1322C arm's length goes further than the 109 SIS Act requirements, because the SIS Act requirements sort of make the arm's length requirements a one-way issue, and that is that the transaction can be no more favourable to the related party, but it can be favourable to the self-managed super fund. 1322C is basically just saying all transactions must be arm's length, so it's not actually distinguishing between who's favouring, who's benefiting. So it's much more aligned to the taxation side of the definition. So a key to be mindful of. So if we meet all those conditions, then we are sheltered from the in-house asset rules, unless our 1322D event occurs. And once that 1322D event occurs, then we lose that in-house asset shelter, which is likely to result in the asset being sold. Now, this is an issue that, again, and I keep coming back to, and I want to get to a point where we're not having to come back to talk about COVID from an SMSF investment point of view, but I come back to what these last 4 years or 3 years have provided, and I think what they have provided is a lot more engagement between the industry and the tax office on matters like these 1322C trusts, and that is that does the punishment fit the crime, and not wanting to use the word crime necessarily, but you know, if a transaction is non-arm's length, then in a super fund point of view, if it's an income related issue, then the income for that year would be non-arm's length, and then the following year we could go back and we can deal with everything on an arm's length basis without any problems. If we do that inside the trust, then the crime is we actually have to sell that trust and move out of that transaction and potentially realise gains and all sorts of other things at a time that we otherwise, plus potentially have the non-arm's length income provisions apply. So not only have we got to fix the compliance side of things, we've also got the tax side of things. So the disproportionate outcomes between a 1322C vehicle and a direct investment is something that was raised at least through the last few years. Whether it goes any further, time will tell, but I think it's one now that's at least clearly on the industry's sort of radar to be able to regularly sort of check in with the regulator and the government about, you know, their thoughts on such a matter. So it's one of those areas to be mindful of. So what are those 1322D events, or those main ones? So the first one is if our membership, which I'll put down the bottom, but is that our membership increases above 6. But, you know, I've said ever since I've sort of discussed this as a subject matter, if your fund membership goes above 6 or back in the day above 4, then I think you've got a lot more issues to be mindful of than just the investments of the fund. So, you know, if we assume that most self-managed super funds don't have that problem, then we're really addressing each trust on its own. And this is a key to the transactions, and the 1322D transactions are, other than that membership issue, it becomes isolated to that specific trust. Now, many of you may have seen unit trusts inside self-managed super funds that own more than one property, right? Now, that can be, from a convenience point of view, that might be all well and good, but what it means is if there is a stuff up as such for one of those properties inside that unit trust, then you may have to blow up the entire unit trust from an SMSF investment point of view, versus investing in each property via a separate trust would mean that if there's a problem with one investment, you're isolating that problem to that trust and not all the other assets of the superannuation fund. So in many respects, there is much better ways to structure it than some parties have gone about over the history of time from an SMSF investment point of view. So what are the things that we can't do? We can't enter into a loan agreement or invest in another entity. So unlike the unrelated trust, we've got to be very restrictive in what we do from an investment point of view and keep it isolated to non-entity related investments, so largely property. That's not to suggest that there aren't other investments that we can invest in, but if we're investing in other trusts or other companies, then we've got a problem. We cannot borrow or give charge over the assets of the fund. So again, this is an area that we need to be mindful of, that if we're investing in the 1322C vehicle, that any leveraging is happening outside the trust vehicle. So particularly, and this was the issue with the Montgomery Walls, is that they invested in the trust that bought property, and then their business used that property to leverage debt that they never paid. And so then their unit trust sold that property and paid off debt, which wasn't actually related to the super fund. So they felt that the fund wasn't operating in accordance with the sole purpose test. So if we're investing with other parties, we need to make sure that any leveraging that they're doing to invest in that unit trust is done outside of the scope of the investments held in the fund. If we conduct a business, then we're in breach of 1322D. If we lease to a related party other than business real property, either directly or indirectly, if we conduct non-arm's length transactions. So again, there I come back to that whole non-arm's length issue and something to be mindful of. If we acquire assets from a related party other than business real property. So that, again, is just reiterating the point from the previous slide where I talk about related party builders. There's nothing wrong with having related party builders engaged in a 1322 structure to build properties. But if we don't have some form of watertight contract in place around the acquisition of the materials associated with that property building, then it could be deemed that we're acquiring an asset from a related party, and therefore we could be in breach of 1322D, therefore unwinding the transaction in its entirety. Now, again, if I come back and flip that on its head and talk about a direct investment in a super fund, with that acquisition of an asset from a related party, what is the worst case scenario? Well, if you breach the acquisition of asset rules from a related party, often the tax office will tell you you have to sell that transaction. There is theoretically large assist penalties, including imprisonment for that sort of transaction. I've never in 20 odd years seen that be applied. So, you know, occasionally the answer to that might be a slap and don't do it again, or somehow, you know, rectify it beyond the means, but not unwind the entire transaction. So again, within the trust, you just need to be mindful of how that needs to work. So the 1322D is one to be mindful of. Now, I did raise this, or I showed this presentation or this imagery at the last one when I talked about property, but just to reiterate it, to show you, I guess, the difference between using a related entity versus a direct acquisition. If we talk about Pat wanting to buy a house from a third party as tenants in common, then he can do this. Can Pat's SMSF acquire the share that Pat has? The answer to that is no. But what if they did it through a 1322C property trust? Then in that instance, Pat and Pat's SMSF buy units in the trust. That can occur. Then the fund can buy Pat's units, because the exemption talks about who did they acquire that property from in the first place. And if that property wasn't acquired from a related party, then there's no restriction under 1322C to be able to acquire it. But of course, if Pat then rents it, it would be an in-house asset. But if it was business rule property, then it's going to be okay. So again, you work through all of the various rules. Gearing is a problem. And if you acquire some other investment, and that's also going to be a problem. So, the whole use of the related entity is a real positive one if it's done correctly. But if we've got issues associated with it, then it's going to cause problems for the fund, not just from a tax point of view, but also from a compliance point of view. Which then makes me want to address this issue of property development, which I've touched on a few times through the presentation, because one of the key issues there was that investing under a related entity or a non-geared unit trust requires that you're not carrying on a business. So the question is often asked about whether or not you can undertake development via that unit trust. And whilst the answer from an SMSF point of view has never been sort of really extrapolated from any case law, there is enough other case law to give us a bit of guidance in this place. But also that regulatory bulletin does talk specifically about a self-managed super fund that invests in a related trust, and then in that related trust they build two residential properties that are rent out to non-related parties, and in a commercial property that is leased to a related party. And they ultimately say that transaction in itself is okay in that regulatory bulletin, but then there's a breach of the lease, and that can create other problems. But let's look at some real situations here. And you've got this WWXY versus a commissioner, and then FLZY versus the commissioner. And they say two quite different things, or have two quite different outcomes associated with property development. Now, these cases were heard along the lines of capital gains tax and the CGT implications of the transaction, but can be more broadly applied to whether or not they're carrying on a business. And in that WWXY fund, a group of property developers bought the property and put in place or had a development plan approved. So they had their development approved by the council, but then through failings of money, they didn't proceed with it. And so they held the property for long term, generated income, and then sold it without actually doing the development. Well, in that instance, the tax office looked at it and said it was about the intention to develop, versus the other situation where they actually purchased property and they started to lease it out. And then in that instance there, they derive rent from it. And they did contemplate doing some property development, but they didn't do that. And then they sold the property. And so that instance, it was created for capital gains tax purposes. So again, it comes back to this concept of objectivity. And what the tax office really highlighted there was, what was the intention of each of these clients or these cases? What was the intention of the original purchase? And so if we're looking at the concept of carrying on a business in the super fund, it's what is the purpose of undertaking the transaction in the unit trust in the first place? Is it to buy land, build property, flip that property, start again, do that, move on to the next investment? Because if that's the case, then it's more likely to be considered, in my opinion, as property development, and therefore more likely to be considered carrying on a business, which then has by extension, things like trading trust issues where the income is treated like a company income, taxed at 30% once it's distributed. Of course, the fund's only taxed at 15%, but if we then go back a step, if you've done it in a non-geared unit trust, well, then it's going to be non-arm's length income because you've carried on a business. And so instead of 30%, it's going to be 45%. So again, it's about really dotting the I's and crossing the T's up front with that sort of transaction versus the idea of setting up the unit trust, acquiring the land, building properties for long-term lease, and then receiving that passive income. So passive versus more churning style of transaction is going to be something that the regulator's looking at with regards to the whole concept of property development, and therefore what that means in the instance of carrying on a business from an ungeared unit trust point of view. Which brings me down then to talk about the concept of distribution. So if we're looking at the differentials between the related trust and the unrelated trust, and the key being really around the transactions that occurs within that trust and therefore the control issues associated with it, then one of the big issues that comes back to haunt a lot of self-managed superannuation fund is the payment of distributions from the fund. Now, what we know is that we have to declare the income at 30 June each year for the trust, and then subsequently the distribution will follow suit. Under SMSF ruling 2009-4, which was the definition of an in-house asset, and broadly provided definitions of all the words within the definition of an in-house asset, one of the things that they incorporated is the definition of a loan. Now, one of the key issues of that definition of a loan was the provision of credit or any other form of financial accommodation, whether or not enforceable or intended to be enforceable by legal proceedings, and includes arrangements for the deferral of payments of debts or entitlements. So what that really started to talk about all the way back in 2009, and the precursor to this was the sort of the end of the transitional period for pre-99 unit trusts at this point. But what this was really identifying was that up until 2009, it was the industry was largely rife with unpaid present entitlements, right? And it was because people were just looking at whether or not they're just going to reinvest them because you could under the pre-99 rules back at that stage. But I think it was largely because we weren't as watertight as an industry with enforcing some of these issues. And so the ATO addressed it under this ruling to say, well, if you're not actually paying these distributions, if you haven't made the payment out of the unit trust to the superannuation fund, then we need to consider that as either an investment in the unit trust, so redistribute or to make that distribution as a reinvestment and give more units, or we need to treat it as a loan, and in which instance it's going to be an in-house asset, and do we need to formalise a loan agreement or whatever it might be to make sure that payment gets offset. Either way, it would be triggered as an in-house asset. And if you then tie that in with SMSF ruling 2009, which was dealing with the unpaid present entitlement of funds, then what that document provided for was a reference to SMSF determination 2007-1, which talked about how you actually paid an entitlement out. And that was that you had to make a cash payment, and then the cash payment would be made at the point that it's made, just like when a contribution's made, just like when a pension payment is made, is when the actual money is received, is when the distribution is paid, or that alternatively, there was an in-kind transaction. So if the distribution was payable, and then there was a swap over of the distribution from being a cash entitlement to a reinvestment, then it would be at the time the decision was made to make that reinvestment would be the time of the transaction occurring. So this unpaid present entitlement is still relevant today because we need to ensure that we're not creating loans in the fund, and we're not creating it. So we're not creating new in-house assets, and it's largely relevant for 1322C investments, because if that 1322C trust has an unpaid present entitlement and we're then treating it as a loan because it's gone unpaid, well, then we're in breach because we've triggered a 1322D event, and we're going to have to unwind that transaction. Similarly, if we've got a pre-1999 unit trust, well, then basically we're not ever going to have a problem with the pre-99 investments, but the new investments would automatically be considered to be an in-house asset. And so we've got to be mindful that if we're dealing in this unpaid present entitlement space, that we're ensuring that the funds are paying them on a year-by-year basis. So not just collating them in the financials of the unit trust and then maintaining or using the capital in the trust for other purposes. And so it sort of brings me to wind this up by talking a little bit about pre-99 unit trusts, because there is a capacity these days to interact between pre-99 trusts and 1322C trusts, but the transactions that we undertake inside those trusts can be like quite different. So the question that we need to be mindful of is that the right way to go? But we know that if an SMSF owned units in the trust prior to that time, then they'd never be in-house assets. Any additional units acquired under the transitional period up to 30 June 2009, they would never be in-house assets. And then anything acquired after 30 June 2009 would be considered an in-house asset. And so this is where I see a lot of accounting issues where, you know, it's rife that a lot of these unit trusts wouldn't have valued assets for many years. And of course, now that super funds are required to, and have for some time now, required to value their assets at 30 June and to commence pensions or whatever, then there's a greater onus on those unit trusts doing a revaluation of the investments. Now, again, this comes back to my original point of ensuring that you've got the appropriate parties dealing in the unit trust financials, because I've seen financial statements where instead of revaluing the asset and therefore lifting the unit price, they've effectively kept the unit price as $1 and just reissued more units to fix that situation and increase the value of the property. Now, of course, what that's done is issued additional units post 30 June 2009, meaning all of those units, and in many of those instances from a valuation point of view, we're talking about hundreds of thousands of dollars, would all be considered to be an in-house asset. So it's about clarity and understanding that people are doing the right thing and just increasing the unit value rather than the unit holdings at that point in time. But it does sort of beg the question as to what you do with that, because you can still borrow and you can still develop within these pre-99 unit trusts. You can still invest in other assets. So they are a very valuable tool if you've got them, but you just got to make sure that you're getting the accounting side of things right. And what it often leads to is that question of, okay, well, if we go back now and tie this in with the distribution comment, it's like if you've got a distribution, you should be paying it. But if you pay it, or if you choose not to pay it but reinvest it, could potentially those pre-99 unit trust reinvestments come under the 1322C provisions? And the answer to that is they can, and ATO ID 2012-52 provided that. They've got to meet the conditions now. There must be no new borrowings since 2000 or 28th of June 2000, and any borrowings that were in place at that point in time must be reduced to nil prior to that investment. So you can conceivably invest in a pre-99 unit trust by reinvesting any distributions, so long as you meet the clarity around 1322C before you do it. But of course, if you don't meet the 1322C requirements and there are still borrowings, then you really need to make sure that the cash distribution is paid out. So what I want to finish on is basically a couple of the common issues that we see with unit trusts as takeaway points, and that is the accounting entries or lack of, and that's the comment around the valuations, loans versus the words unpaid present entitlement, so distribution accounts and things like that. Making sure that people are doing the right thing is critical to make sure that from an audit point of view, they're not coming under any sort of issues. The control issues, checking the deed of the unit trust to make sure that parties that you don't think control it don't control it. So you're wanting to make sure that there is no control issue, therefore triggering a related trust investment if you've gone to the effort to try and set up an unrelated trust. making sure that the distribution rules are understood and that people are paying those unpaid present entitlements as soon as they possibly can. Appreciating that a lot of times unit trust financials are the last thing that the accountants finish each year, and so therefore the distributions often come late in the financial year. That's one of those sorts of work in progress areas that, as long as there's consistency there, most people aren't too bothered with that. But it's when you see that same amount being carried forward that's going to be creating problems for the fund. Asset valuations is clearly an issue that has been addressed over the last sort of 5 to 6 years, but will continue to be addressed as auditors require more around property transactions. And then related party transactions. So if we are undertaking any related party events inside those trusts, that we're doing everything on a commercial basis. We're not acquiring assets from related parties. We are leasing investments on arm's length terms and undertaking all the transactions commercially. So that's a very sort of broad overview of unit trust investments inside self-managed superannuation funds, related versus unrelated, and how they link to the pre-99 unit trusts. Next webinar will be on the 5th of October.